Hello everybody, welcome to DFT Lesson 10. Today we'll be talking about credit. And so we'll be understanding credit today. So credit is essential in personal finance. It's especially important for adults to understand credit for effective money management. This guide covers the basics and advanced concepts of credit in a clear manner. So let's see. What is credit? Credit is an agreement where borrower receives something of value now and agrees to repay the lender, which is the person who's giving the money, usually with interest. So therefore, you're getting money from a lender, somebody who like credit card company, and you will be paying the money back with an interest rate. So an interest rate is paying a percentage of the borrowed money as the cost of borrowing. Because of borrowing money, I am paying a cost for it. So for example, Sarah buys a refrigerator for $500 using a credit card. She will pay back $500 plus any interest over time. Therefore, with an 18% interest. If she only pays the minimum amount each month, it will take longer and cost more. So what is a credit score? A credit score is a numerical representation of your credit worthiness. So a higher score means that you are more worthy of your credit. So a score range would be from 300 to 850. So credit scores are calculated with your payment history. How much do you pay on time? The amount you have owed, therefore your total credit and loans versus your credit limit. So how many times have you used the credit and loans compared to how much credit you can use? Then you have length of credit history, which is the duration of your credit use. How long have you been using your credit for? The new credit, that means the frequency, that means the amount of new credit inquiries or accounts. Then you have types of credit used, which are the variety of credit accounts, such as credit cards, mortgages, and etc. So John has a credit score of 750 due to timely payments and low credit card balances. This helps him get a low interest car loan. Because of having a high score, he can have more advantages within the bank and services. So a credit report is a detailed record of your history. So this information includes your personal information such as name, address, your credit accounts such as loans, credit cards, your payment history, your public records, and you have inquiries when someone checks your credit. So Maria's credit report shows on-time payments and well-managed loans, helping her rent an apartment. Sometimes people might ask you about what your credit score is if you're trying to buy a house or if you're taking a loan out. And if you have a higher score, it's more likely that they will say, oh, you're worthy of, you have a high score, I'm going to guarantee get my money back. So that's why. So now we'll look at each different types of cards, such as credit card. Now, credit card is borrowing money up to a limit for purchases or cash withdrawals. The pros are building credit history, rewards such as cashback points, and it is better fraud protection. Cons are that you might get debt. There might be high interest rates. For example, Lisa uses her credit card for groceries and pays off the balance monthly, building her credit and earning rewards. Debit card, linked to a checking account. Money is immediately deducted. Therefore, there's no risk of debt, no interest charges, but the cons are that it does not build credit history and there's limited fraud protection. So Tom uses debit card for coffee. This amount is immediately deducted from his account. So now credit card is used for your, it helps you build credit, offers you rewards, but it can lead to debt. Debit cards prevent debt, but don't build credit. So that's why you might want to have both, not a single one. So next you have steps to build good credit. You want to pay bills on time, you want to keep your balances low, you want to limit new credit applications. Therefore, too many inquiries or too many new credits can lower your overall score. And monitor your credit report. So if there's an error in your report which leads to a lower credit score, you can contact and fix that mistake. Therefore, your credit score will increase. So here are some strategies to maintain good credit. Stay within the credit card limits. Manage your debt wisely. Use the snowball or avalanche method to pay down your debts. Then you have keep old accounts open. So before I go into this, I'll talk about the snowball or avalanche method. Snowball methods are covering all the small term costs and then going to the long term, whereas avalanche is removing the big cost and then going for the small ones. Therefore, you can manage your debt easily. Now, people might say the avalanche is better or the snowball is better. It does not matter. It just depends on what the costs are and what you think is best for you. So you want to keep your old accounts open. That means longer credit histories boost your score, and use your credit responsibly. Then we have types of credits. You have installment credit and revolving credit. For example, your installment credits are fixed payments over a set period of time, and revolving credit is borrowing up to a limit and repay as it's being used. Now we'll be understanding the interest rates. Now you have the interest rate is a cost of borrowing money expressed as a percentage. Lower interest rates means less cost over time. For example, Alex prioritizes paying off a credit card with a 25% interest rate over one with 15% to save money. Now, when you have a credit card or debit card, or you really want to avoid identity theft. You want to keep your personal information safe. You want to monitor your accounts regularly and check your transaction history to make sure nothing is off. You want to use very strong passwords. Nowadays, online, you can hack into other accounts and it's completely wrong. So you really want to be safe out of here. So for example, Carla deletes a phishing email and checks her credit report regularly for unusual activity. So now you want to handle credit issues. Now, if you have any credit issues, you want to contact the credit bureau to fix the report errors, or contact a financial advisor or a credit counselor if you're struggling with debt. Now, for example, Brian disputes a late payment error on his credit report, improving his credit score. Like I said, if there's an error, you really want to make sure that you get it fixed so you can have a higher credit score. Therefore, you'll be having more additional services, benefits, and etc. So to conclude, understanding credit is key to managing your finances. Maintaining a good credit habit and protect your credit to achieve financial stability and goals. Successful credit management is about knowledge, discipline, and responsible use. Thank you.